So let's look at a hypothetical situation. So we have OICX, and the stock is trading right around 100. And we're looking at the August 95 cash secured put. Okay, maybe stock rallied from 90 up to 100. We're not comfortable chasing it, but maybe we buy a little bit at 95 on a pullback. Okay, so we see that we can sell the 95 level put for $3. So that $3 is ours to keep. We put that in our pocket. So remember that every option that we sell has 100 multipliers. So if we sell that option for $3, we're in fact going to be taking in $300 for that contract. That is ours to keep. Now, because we're going to be short the 95 level put, we're going to have to deposit in cash $9,200 with our broker to collateralize that potential obligation should we get assigned, okay? Because if we get assigned, we would pay our strike price times 100 or $9,500, but we took in $3 also to do that, which basically the cash deposited would only be $9,200. So in this case, we would have, for every put that we sold, we would have to have $9,200 in cash to collateralize that obligation, which is why it's called a cash secured put. So once again, we're doing so if we are kind of neutral to moderately bullish, or we want to maybe buy the shares on a pullback and then hopefully get assigned in the stock rallies. We're also looking to generate premium income. And every time we sell those puts and they expire worthless, that's income in our pocket. And ideally, the target buy-in price is, below where the share price is currently trading. So once again, it's that idea that we're getting paid to wait for the shares to get to a level that we're comfortable buying them at. So once again, in this case that we're looking at, the maximum gain is if we are unassigned and the puts just expire worthless is the $300, because when we sell options, the most we can make is the premium that we take in for those options. If we get assigned and we get long the stock, well, our upside gain is unlimited, because theoretically stocks can go to infinity. There's no telling how high a stock can go. So we have unlimited upside should we get assigned. Our maximum risk is $9,200, because we would have to pledge that $9,200 to collateralize the short put. And that is our maximum risk if the stock went from 92 all the way down to 0. The capital requirement is $9,200. And our break even, okay, even though we're going to be long stock from 95 if we get assigned, we took in $3 for that put, which effectively lowers our break-even price from 95 down to 92. So effectively, we have risk from 92 all the way down to 0. In other words, our strike price minus any premium that we take in for that put. So let's look at it, the same position in graph form, and sometimes it's easier to visualize it in graph form. So this is the exact same position. So we have the, if we own stock, if we didn't sell the cash secured put, we would just own stock from 100. And this is the P&L graph, okay? Below 100, we lose money. Above 100, we make money. The cash secured put, this is the graph for the cash secured put, okay? We take in $3 for that put. We have to deposit cash with our broker of $9,200. Our break even is 92. So if the shares go below 92, we have 1-for-1 risk all the way down to 0. If the stock goes higher, goes to 105, 110, 120, if we don't get assigned, the most we can make on this position is $3 or $300 per contract, okay? So the maximum loss, once again, the maximum gain on this position, if we don't get assigned, is 300. If we do get assigned, we have unlimited upside from 92 all the way up to infinity. And our maximum loss in this case is $9,200. The shares go from 92 all the way down to 0.